Let's welcome then on board our very first guest. We have with us Amit Kukreja, founder of Amit Kukreja Advisory. Thanks so much for joining us today on the Money Show, Amit. So let's talk about, many people say that, okay, yes, I want to invest my money and I want to put it in equity markets, etc. I have been saving XYZ money and now I want to invest it. How important do you think it is to invest only keeping a goal in mind? Should you just simply invest your savings off in a sporadic manner, or do you think it's better to have or to create some goals before you start your journey?
Thank you, Mubina, for having me on your show. Let me start my answer. We always start writing down our life goals. If you are that kind of a thinker, you would start with what exactly do you want to achieve in your life? And in order for you to achieve that life goal, what is the amount of money that you want to have in place so that your life goal can be achieved? A lot of parents take pride in being a provider and being a protector for their children's education, children's marriage. A lot of parents take pride in being ready for retirement. A lot of parents take pride in being ready for upgrading the house. And they link these accomplishments and achievements in life with their life goals. So if you're clear with your life goals, you will eventually become clear with your financial goals. And once your financial goals are clearly written down on a piece of paper and an action-oriented plan is created for those financial goals, you will get into the investment strategy. You will get into the investment execution. You will get into the cash flow planning aspect of it. That is the execution part of how are you trying to make your money work for you. So yes, it is of paramount importance that you have a very well-defined financial goal and a financial plan to achieve your financial goals, because that is eventually going to help you achieve your life goals, which will create a very fulfilling and happy life for you. So the more aligned you are with your financial goals, the more aligned your financial goals are with your life goals, higher the probability you will achieve fulfillment and happiness with your financial planning process.
Now, Amit, some people don't think so long in their life, and especially the younger cohort of our population, where your ambitions, your dreams change perhaps every half a decade. So in such a situation, and why not, right? I mean, in today's day and age, you have so many disruptions coming around, and it's I guess an accepted norm for people to switch careers, just to give you an example. So why not their goals and their ambitions? In light of that, keeping in mind the constant change in ambitions, how would you recommend, especially the younger population of India, sort of kickstart their goal planning and noting down their life goals when they themselves, and more so at a younger age, don't have exact clarity on that?
Spot on. I mean, there are two things. When you are younger in your life, obviously there is a lot that you have not seen, and hence the clarity is missing. There's another difference why younger people do not have clarity. It's called the generation gap also. Like if you start talking to people who are in their early 20s, they'll probably be able to speak more on cryptocurrency than any mutual funds or stocks portfolio. So you're very right in calling out that a life stage will automatically determine why your financial planning is important. A life stage will help you navigate through the experiences in life and help you gradually realize the importance of financial planning and investments planning and goal planning. For early investors or the early stage people who are career beginners, for them, I think there is still some clarity on their short-term goals. They may not be having the clarity on the long-term goals, but they do have the clarity on the short-term goals. They can start investing for their short-term goals. They do know that the power of compounding is very powerful. So in order for them to experience the power of compounding, they can start small investments for long-term where they don't feel their goal will be compromised or sabotaged. So I think even if you are a younger person, even then you have some goals. You need to tag your money to your goals and make sure the investment is done accordingly. The rest life will bring in terms of experience, and as experience comes, as you go through different stages of life, you will realize the importance of financial planning and the early planning in your life so that you're able to fulfill all your goals. It's a gradual process which basically becomes stronger with experience. And we just have to let the younger people go through their experience to realize the importance of goals planning and investment strategy.
All right. Now, as you grow older, you have family members that depend on you. It could be, dependent parents, a spouse, your children as well. How do you then go about setting goals, keeping in mind, your family members? I guess it's a little easier. You have more flexibility when you are alone, but when it's a family, you need to realize that the financial decisions you take today will have ramifications for your family members as well. And also, I'm going to add in one more question. When you set goals, how should your family as well be included in that process for the same reason? How should you talk to your children as well about something like this?
Yes. Yeah. Good question. And it's going to be a long answer, Mubina, for this one, because we are talking about family members. When it comes to planning for family, you need to keep all stakeholders in the loop. You need to speak to your parents if you are supporting them, redesign or rejig their portfolio so that their financial requirements are met in a timely manner. So sitting with parents, understanding that they cannot take a lot of risk in their investment planning is an important step. Sitting with parents and figuring out that it's going to be mostly a conservative investment strategy unless they have much more money than what is needed by them. So you have to sit with them, figure out what is the kind of risk they can take in their portfolio and what is the kind of liquidity and capital protection they are most comfortable with. When it comes to family financial planning, you have to sit with your spouse. Even if the spouse is not earning, if the spouse is earning, obviously the conversations are longer because you have to be aligned in terms of financial goals and amounts and risk tolerance and the time frame we have to achieve those goals. But if the spouse is not an earning member, she's a homemaker or he's a homemaker, then also you need to sit with the spouse when you're doing your sheets, because you do need an external validation of what you're planning. You might miss out due to your own blind spots, certain perspectives on money that the spouse might bring it to your attention. So sitting with your significant other, irrespective of the earning status of that person, that process needs to integrate the other person's opinion as well. Now let's talk about children's planning. So there are two ways you plan for your children. One, obviously you plan for their education. In India, unfortunately, we still have a lot of self-validation happening if we are planning for our children's weddings also, which I normally discourage parents to do that. But unfortunately, we have a cultural nuance here where parents take pride in planning for their weddings also. But when you're planning for your children, make sure children are made aware of the financial costs that you are incurring to help them become mature, responsible adults. So that's one part, which is providing and being a protector for them. The other part is setting them free to build the experience in life. So children need to go through their own painful or gainful experiences in life where they understand the value of money. Some mistakes with respect to money decisions is good for them. They will learn their lessons. And some gains out of their own money decisions where the money has grown faster is also good for them to learn the lessons of return on investment. So only enabling them to go through the experiences, only making them aware how much money you are incurring and accumulating to incur the cost of education, and then sitting with your spouse and parents. It's a detailed conversation-based processes that you need to go through to ensure your family is set up for success with your financial process or financial planning process.
I completely agree with you, Amit. It's a cultural norm really for parents to spend big on children's wedding. That's in fact very often listed as a goal as well by most of our viewers. But in today's day and age, your kids, by the time they get married, they'll be 24, 25, 26. In all likelihood, they'll be independent as well from a financial perspective too. So at that point of time, I suppose that individual himself or herself will realize, the value of money and whether or not he or she wants to really splurge it on a wedding. Of course, thanks to COVID, the wedding budgets have really been saved big time. So I think maybe, Amit, we should do another session on how to invest all of that money you've managed to save from, splurging on that big fat Indian wedding. but maybe we can keep that for some other time. But let's talk now about investment strategies. You know, the headline in the last 2-3 days for Dalal Street has been Nifty at record highs. Nifty crosses 17,100. That bull run, which seems to have kick-started from almost a year and a half ago, or almost 14 odd months ago, or there seems to be no stopping it. It only continues. I'm sure your clients are calling you and asking you that, okay, what should we do? Should we book out? Should we stay on? What would you recommend as a mutual fund strategy, as as an investment strategy for viewers at this juncture?
Sure. So very simple, Mubina, and I'm glad you're asking this question because there are a lot of mixed opinion about the market situation. I can say, and this is just my opinion, that currently greed is dominating the investor's psychology or the investor's mental makeup. They are seeing the returns that they have seen in last 1.5 years. They are actually presuming that the same kind of returns are going to be coming to them every year in the market. I have a very conservative approach towards investments at this juncture. I think market is overvalued. I also think the unreformed sector of the economy is not correctly reflected in our market movement. So I personally do not see a complete economic representation in the market, but I see a good side of the economic representation in the market, which is attracting international money. So instead of being focused on investing according to the market movement, I would request and appeal to all the investors to be focused on looking at your investments from the goals planning point of view. If the money that you needed for your goal has already been accumulated, please take that money out from risky assets and move it into low risk assets, because now the protection of that money is very important for you for the timely availability of the money for that goal. If the goal that you anticipated is still away from you, then continue to focus on the markets. Now, look, if the goal is within 3-year horizon, my request is going to be the same. Pull out money from risky assets and keep it in capital protection assets, and do your replanning based on the conservative number on the remaining 3 years. And if the goal is beyond 3-4 years, up to 5 years, keep the money in large cap and index funds. And if the goal is more than 6 years away from today, you can continue to stay invested in multi-cap, flexi-cap, sectoral, thematic, mid-cap funds. Of course, based on an annual or biannual review processes. So take a call which is based on your goals rather than based on the markets. Market factor is secondary, goals factor is primary. The rest is how you collaborate with your advisor to make sure the money is growing as per your risk tolerance or risk capacity.
All right. So your strategy for investing and redeeming your mutual funds should be more based on your goals. If your goals are coming closer, Amit had recommended the few chops and changes you may make. But if it's more than 5 and 6 years away, really stay put and don't get too carried away by the temptation of thinking that, okay, let me just redeem a little bit and enjoy some of those profits. Because if you're looking at more than 5 and 6 years, there is potential for the market to return even more. Yes, there may be some short-term volatility, which is usually the case with equity markets, but keep the long-term picture in mind, especially if that's the kind of time horizon you have. Time is on your side really in that case, so enjoy what the power of compounding can do. How do you Amit, the tendency also for a lot of our viewers is that they want to continue holding on to what they have, whether it's in terms of individual equities and shares or in terms of equity mutual funds. Now, in many cases, we see that the share or the mutual fund is not performing as well as we have seen the market perform. It's underperforming. So, how do you sort of review that and get rid of what we call as the that biasness that you tend to have towards what you already own, even if it's underperforming or it's not doing as well?
Yeah, we call it recency bias. We also call it familiarity bias. Recency bias is basically you are holding on to the performance pattern that the investment had shown you in recent past. Familiarity bias is like being familiar with the known devil, then becoming familiar with the unknown devil, right? So these biases do come in picture. Also, there are some blind spots. Blind spots could be your affinity for a particular sector because you belong to that sector, or the blind spots could also be that you have some other logic some other logic that makes you hold on to that investment. So an external validation and confirmation bias or validation with somebody else on whether we should hold on to that investment or not hold on to that investment. How does the cash flow or projected cash flow of a stock in future is looking like? How does the overall market look like as of now? In the coming times, what sectors and what parts of economy will do well and what are likely to not do well? You need a holistic evaluation with an expert, with an outsider, and then you accordingly take a chance to challenge your own assumptions, work on them, and then accordingly rejig or reset your goals and rejig your portfolio. So it's a little longer process, but I can say that you can overcome these biases. It's fairly easy if you have the right partner, or I call it a thinking partner with you to think and plan about your investments. It's doable.